There is this friction in the system that affects everyone on Earth, anyone who ever borrows money. And by making this flexible, their lives get that much better.
How did the four of you, how did the team come together? What's the origin story?
Why don't we start at the beginning with Eric?
Yeah, so the germ of the idea for PACT started back in, I think it's 2021, when Dylan and myself, our CTO, we were working on a previous company called Node. And this company was trying to do non-custodial banking as a service. So rebuild, what you see at Unit and Cross River, these other banking as a service providers, but built entirely end-to-end using non-custodial blockchain primitives. So think non-custodial wallet, non-custodial yield, swaps, remittances, etc. In the early days, we were very scrappy. We were working with other startups, trying to find our footing, find our product market fit. And Fabian, from an early stage, he was like, so Fabian, our CEO, he was our main investor in that company, and he was pushing us to focus on microcredit as a use case. His main idea being he was seeing all this work that was being done in the RWA space, very experimental, and he recognized that none of these protocols were actually trying to leverage blockchain to improve the lending process. They were leveraging blockchain to raise money.
So using it as a branding asset almost, like it's on chain, that's why you shouldn't.
Yeah, it was a branding asset, and they were trying to raise capital, money from people who are on chain. Yeah. But they weren't actually trying to change the fundamental infrastructure of how the loans were made or sold. They were just like, oh, there's a big pile of money over there. Let me go tap that big pool of money.
I think it's a pretty common thing in Web3, isn't it?
Yeah. We have a pretty core philosophy that, there are two, they've heard me say this all the time. I came from a traditional finance background. I ran origination businesses, worked on student loans, worked on mortgages. And in that industry, which is the industry that we work with, there are really simply two ways to make money. You either have cheaper cost of capital or you have cheaper operations. And the rest is largely noise. And what everyone was doing was saying, whoa, look at all that cheap capital on chain. Let's go get that. And that's good. There's nothing wrong with that. But the really sustainable, defensible advantages in running those businesses are when you make the operations of the business more efficient, when you actually reduce costs in the system. And then you just have a competitive advantage over everyone else because it's cheaper for you to make a loan or sell a loan. And what we are trying to do, and what Eric was doing back then with Fabian, is to really make those operational changes that are fundamental to the business, not just a cash grab.
So why are people not doing it?
It's hard. So when you look at these other RWA protocols, right, they're just a protocol. But if you want to do what we're doing, you need to build real infrastructure off the blockchain as well. And so, PACT technology is embedded inside fintech Android applications, for example. We have an Android wallet SDK that gets integrated within Android apps that touch millions of customers. And, this is going back to the germ of the idea. Again, we started with embedded wallets, non-custodial banking as a service. So the hardest part that I see, the embedded element of it, the infrastructure to actually let these end consumers touch your protocol is where we got started. And then we built the capital markets layers on top of it. But we built the integrated piece first, which from where I said, that's one of the harder lifts to get off the ground.
And that's why people don't do it. So you felt like there was a big gap. Fabian was an investor. And he was pushing you towards more micro loans, right? Micro lending, right? At what point did he decide, I'm going to join this team and this is what's going to happen? Lending, fully on-chain lending, right? Securitization as well. How did that happen?
It felt like a very slow, natural progression towards this, I would say. We had funded a pilot in Brazil. So I had actually put up some of my own money lending to micro entrepreneurs in Brazil. We had followed on with a larger pilot where Fabian had also contributed some capital. And I think it was just sort of like a natural progression over time. It was like, okay, we're onto something here. I think there was also some entrepreneurial spirits in Fabian wanting to get back into the startup world. And so, it was during a time in the market where things were pretty slow. I don't recall if it was a bear market, but it was after FTX and all that. And there's just an opportunity to really focus on where's the missing pieces in this ecosystem, where's the value to be made.
And I think part of what, you asked why it was hard. I joined a couple of years ago, just as this was all, the same period, just as it was all coming together. But it's very easy to go out and buy an asset and sell it to someone else. which is what a lot of the people in the RWA world were doing. They would buy an asset, put it on chain, they would record the data from the asset they just purchased on chain, and then sell it. Great, there's nothing wrong with that. The real unlock is embedding the protocol in the lending process so that when the borrower in Brazil, in Kenya, in Kansas repays their mortgage, repays their student loan, repays their credit card bill onto an app, whatever their banking app is that they're using, that automatically lands on PACT's rails from the outset. When the loan is originated, it's originated on PACT. All the data is there from the get-go. And what that means, I use this metaphor, that we build plumbing. We're plumbers. We build financial plumbing, but we're plumbers. And in credit, the plumbing is really complicated. And you've all heard about 2008, the great financial crisis, and asset-backed securities, and how they're all cut up into A and B and C tranches and then repackaged, and they're so complicated that no one knows what's in them. All those contracts are effectively the plumbing to tell the system where the money should go. When you repay your loan, who gets it ultimately? Those contracts tell you that. And today, you have to hire a bunch of accountants and lawyers every time that a transaction happens to make sure you understand the plumbing, because it's quite complicated. That's changing all the time. And so if you use the plumbing metaphor in your house, if you move the kitchen sink from one room to another room, right now you have to go out and hire a plumber to move the pipes from the kitchen into that other room, and that's expensive. We build magic plumbing that automatically moves as you move that kitchen sink, and you don't have to hire the plumber, and you don't have to hire the accountants. It's just
one system
that is flexible enough to keep moving so that when you make your payment on your loan, it just follows the pipes as they move all the way through. And what that means is that your interest rate on your loan is lower. The costs for you are lower because some portion of the interest rate that you or anyone else would pay is going to pay all those lawyers and accountants, all those plumbers, to redo the piping and make sure it goes to the right place. If you don't have to pay them, that means that you or any family gets to buy a bigger house. They get to buy a house in a better school district. And their monthly carrying cost of that home falls significantly. There are loans where 20% of the interest rate is going to all those lawyers and plumbers. So if you can remove 20% of the costs, that's thousands and thousands of dollars back in the pockets of consumers, of borrowers, of individuals, of families. And so we are very motivated by this, that it's not just like, oh wait, there's some cheap capital over there. There is this friction in the system that affects everyone on earth, anyone who ever borrows money. And by making this flexible, their lives get that much better.
You talked about on everywhere on earth. Credit access is very different based on the country. I know that at least we're still in the early days, but in the early days, one mission for PACT was to make it more accessible to emerging markets. What is the difference in a market like the US, where it's fairly accessible but very expensive? And other places, India, you mentioned some places in Africa, South America, where it's actually hard to access in the first place.
Yeah, go ahead. I was actually going to add to that. On one side, we're lowering the costs. On the other side, though, we also work with lenders that focus on individuals that don't have access to the traditional banking system. They're often one of their only options for a loan. And so we also work with them to expand credit access, because by driving down their costs, they can now take that risk on that new borrower that they weren't sure if it would work out or not. Since their cost to borrow, their operational costs are lower, they can actually extend that loan now. To your question about, the global focus of PACT, yeah, our core belief is that outside the US is where the biggest benefits are to be had from the technology. Now, also noting that the US is by far the biggest market. And so we're going after everything, but we definitely have our roots. We started in emerging markets, and it is quite different. The way that the nuances of regulations in Kenya are quite different than a place like India, which means that the extent at which we can actually leverage certain aspects of the blockchain vary per market. And that's part of the core offering that we've built as well, sort of this compliance layer on top of all the technology to tailor the offering based on the specific market. But I don't know if you wanted to touch more on the extending access.
Yes, I mean, a lot of our operations so far have been in Latin America, East Africa, South Asia, Southeast Asia. And part of the reason for that is that the credit markets are just less developed and the costs are that much higher. So if we can improve it, the costs fall more for the consumer. And there are certain types of loans that just can't be originated with those high costs. So new types of loans suddenly are possible and new groups of people have access to credit. But it's the same problem. It's just a smaller, like the US capital markets are very efficient already, relatively, but they still could be more.
Yeah.
Like back to the plumbing analogy, if you were just moving the sink between rooms, that's like moving it within the US. But what if you wanted to move it across the country or to another neighborhood?
Yeah.
That's like once you go cross-border with the credit space, complexities compound.
So it's upgrading a system that's already working fairly well, but there's a lot of room for improvement in places like the US and the West as a whole.
Yeah, so look, I ran origination businesses and people that I issued loans. That's what I did. And it works. People can borrow money today. It's not that they can't borrow money, but there's this invisible friction through all these intermediaries and middlemen that are sitting behind it, and it's all obfuscated. You as the consumer don't see it. You just get told, my interest rate is this. But part of that interest rate is going to pay all of those people. And if there are more efficient ways to do it, that's just an immediate benefit to the consumer.
So question then, if it's a benefit, a lot of time I feel like when it's a benefit for one side of the equation, then it means it's against the benefit for the other side of the equation. In this case, it would be beneficial for the consumer, probably not for the institutions who are making a lot of money off of it.
So I think we're jumping to like one of the downstream effects of one of the core, like the core benefit is making these assets safer, more investable for the capital providers. And by convincing them of that, they are okay taking a smaller, if we're looking purely from that angle. But then on the operational side as well, these are costs that aren't exposed to the lender, like to the capital provider, but more factor into the lender's unit economics of like, okay, we're raising money, we have this cost of capital, but we also have these operational costs when we issue a loan and manage a loan book. And so that also for that lender now, when their costs go down, they further can drive down the pricing of these loans to their end borrowers. So it's almost like a byproduct of improving the efficiencies for both levels of capital providers.
It's the first time having been in fintech for over a decade, it was the first time I saw an application of blockchain in the real world, like in the non-blockchain world, where there were immediate benefits to all the parties involved, save perhaps for the consultants that will not be paid anymore. But they will find great work somewhere else.
Yeah.
It was so clear. In my whole career, I've never believed as strongly that an industry will adopt a certain technology as I do now that the credit markets will adopt a blockchain technology for both the data of the loans and stablecoin flows through it for the repayment of the loans. It will happen. It just is happening. The benefits are too clear.
Why do you guys believe, I feel like it's been making a lot of progress, but that the adoption and the finding of product market fit has still been pretty slow. Why do you think that is? Because you have a lot of faith, as do I. That's why I work in this space as well, right? Why do you think it's taking so long?
Do you want to go first? I have an answer, but happy to go.
I mean, easy answer is just regulatory clarity, especially where we sit, multi-market, right? The Genius Act is a tremendous tailwind here in the U.S. Doesn't do a whole lot for us in other countries, at least not yet. I would say also there's a lot of we sort of say internally slowly then suddenly, and it does feel like we really are approaching the cusp of the suddenly aspect. You're seeing it grassroots with new fintech startups being built from the ground up, stablecoin native. You're seeing it with the big banks as well, converting over. And I think what we're actually going after is sort of more like middle market. We're also going for big market as well, and the smaller startups as well. But what we're going after is really the scaled, but not yet like JP Morgan size financial institutions that are also looking to do the transition as well. And, we're talking to all these firms, and there's definitely a lot of development taking place, and very different from past cycles where it felt a lot more grifty. This is now coming around to it to where people are starting to see real tangible benefits, even if it is as simple as there's users there. There's legitimate users there. But down to how can we use this to actually drive down costs of our business as well?
Yeah, I think the answer is to your question of why so slow? Why is it going so slowly? The world that we work in, $10-trillion industry with some of the and in that industry, some of the largest financial institutions on earth are the ones that run the show. And they are incentivized to prudently adopt new technologies, but they are not incentivized to rashly adopt new technologies. And that's for the good of all of us. They are the largest financial institutions on earth. We want them to move slowly, calmly. We don't want them just...
Risk tolerance needs to be low enough.
Yes.
Yeah.
And so we're in a moment, though, where they are seeing the benefits of this. And they are starting to dip their toes in the water. They're starting to run their experiments. And this is partly why I so firmly believe that at some point in the near future, they all will adopt this. There's a question of how they'll adopt it. There's a question of who will build it. Hopefully we are the ones.
We are.
But that is what is taking their time, why it takes their time. And it's part of why we operate differently than many blockchain companies. Sometimes we move very fast for TradFi, but we move very slowly compared to some. And that's because that's the only way you can judiciously, safely implement these when people's actual lives are on the line. Lest we forget, it gets abstracted away. But at the end of the day, what we're talking about is a family who is trying to make their monthly mortgage payment. It is literally their home. It is their student loan. It is their credit card bill. It is like the core things in a family's budget. And we want to make sure that we serve those families well and that that the systems are stable, that they work together, and that their cost of life falls in a good way. So it's cheaper for them so they can move to a better school district, so they can afford that education, whatever it is.
So balance between make it happen fast so that it can impact people soon.
Yeah.
But also being careful enough that you don't make a massive mistake that would impact negatively people that you're actually trying to help.
Yeah.
Right before I walked over here, I got off a call with a new partner of ours, which I'm sure we'll announce here soon. They have millions of customers. This deal to close took many months. Close 6 months for this one partner. And part of it is that, we're effectively asking them to hot swap out the entire way that they lend money to customers and move it over to stablecoin rails. Big decision to make. And the call this morning was specifically focused on the on and off ramp piece, right? Like, how do we implement this in a way to where the person that needs the money right now is not confused about, I now have a balance that is not a debt balance, but like a cash balance in the app. It's something that's new for their customers. And so, we can rush something out that is much more like a pilot, but we don't want to do pilots. We want to scale. And so a lot of it spans both the capital markets piece of, leveraging stable coins to fund your financing activities, down to the product team and figuring out how end customers will interact with this.
I feel like, just very quickly, what you mentioned, the on and off ramping, I feel like has been a massive issue for a couple of years, especially if you're not someone who's trying to interact with the blockchain intentionally. It's usually a lot of friction and not very smooth and quite confusing. So makes a lot of sense.
To this day, even when we were working on the last company, Fabian and I would say all the time, on and off ramping is one of the biggest dominoes we gotta get to tumble. And excited to say we will be with this new partner. We will be making significant progress on that.
One last thing, we say we're not moving quickly. That's partly because we want to move so quickly, but we're being prudent. But in the last 9 months, we brought a little over $1.8 billion worth of loans on chain. We've raced up the leaderboard of RWA platforms. I believe we're 4th in the world at this point, and at this rate, we'll be in the 2nd position come the new year. So I don't think we're moving slowly, but the industry as a whole is moving This giant industry with immense mass is moving slowly.
Not talking about PACT moving.
Oh, it's okay.
Let me rephrase this. Talking about the industry as a whole, if there's such a huge benefit,
Yeah.
It's been over 10 years. Why are we only starting to really do it in a way that's scaling and actually impacting real users now? That's the question, which is industry-wide. It's not PACT.
It's like high school physics, like momentum is mass times velocity. You have this giant mass of one of the largest industries on Earth. And it's this boulder that's rolling towards this. And while its velocity might appear slow, the momentum is enormous when you have all that mass moving.
One question, why did you guys pick, out of all the layer ones that exist out there, Aptos?
Our typical loan is a $50 micro loan issued in a third world country. These lenders are used to, when they issue a loan, at least like the loan issuance itself, not factoring in the full process of also now raising money with this loan. But when they issue a loan, it's an entry in a database for them in the normal world. It's free effectively. If we want to do this on even an efficient EVM chain, it's going to cost several cents to issue that loan, transfer the stablecoin to customers, create the NFT representing that receivable on chain. And our customers are issuing thousands of loans a day. We're talking about improving their bottom line. That is taking them in the opposite direction. Versus when you look at a network like Aptos, where it is, as far as we can tell, the cheapest to do what we do on chain. In addition to that, you have some nice features, like we get refunded anytime we retire a loan. When it pays off, we retire the NFT, we get a storage refund. It's also, so that is by far the biggest reason, low costs. It can also support massive throughput. And so we have lenders that'll do 1 million transactions in a given day, and they need reliability. They can't have a network that has downtime to where they have to tell their customers, oh, sorry, we couldn't distribute your loan right now. Come back in an hour. And I think those two are by far the primary reasons. There's also a sufficient amount of key primitives on Aptos. You have the stable coins, the developer tooling, other reputable financial institutions on the network as well. But really it's cost and speed.
Cost and speed. If you had to describe Aptos, it would be cost and speed.
Cost and speed. Plus, they're fun to work with.
They are? We are.
You are.
Great. Amazing. One last thing would be, what makes you guys, and we talked about this in the infrastructure and the way you guys are doing things and the plumber illustration. If you had to very briefly describe what sets you apart, what makes you different in the RWA space, in the stablecoin infrastructure, in the loan, what would that be?
So in credit, so first, we're tokenizing credit. That's our platform. That's what we do. And credit is distinct from equities, from all these other things. And it's distinct in part because of those complicated contracts, those waterfalls, those securitizations that I was talking about. Those are just much more complicated than equities. And so those complications mean that the benefits of tokenization are that much higher.
Yeah.
The market is also way bigger. So that's the first important distinction. We do credit. I believe credit is the best application of tokenization out there, hands down. Better than all the rest. All the rest are primarily, there's cheap capital out there on chain. Let's connect that cheap capital to this asset. But you can go out and buy a share of Tesla, like at your brokerage account already. You just can. And if you get a tokenized one, it's slightly better. There's some benefits, but
it's not that much of a difference.
Relative to the benefits in credit, it's still great and still better, but relative to the benefits in credit, not as much. The second thing that just sets us apart from all the people in credit is that our protocol is embedded all the way through to the wallet on the Android phone or the eventually the iPhone that someone is repaying their loan into. Most people are just going out and buying an asset and bringing it on chain. We're originating the asset on chain from the get-go. The repayments are happening on chain, and that is what makes the magic happen, where when they're repaid with stablecoins, they can flow through instantly, as opposed to someone making their repayment in fiat, taking that fiat, bringing it on chain, finding the data on chain, putting it through. It's sort of like you built to use the plumbing analogy, it's like you built the plumbing from the street all the way up to the front door, and then you're taking buckets and filling your sink with buckets and bringing it out to the front door and pouring it in the pipe. Our pipe goes all the way.
Magic plumbing.
Take that just one step further briefly. Now, because we have all this data and all these stakeholders and all these cash flows on chain, we can also take the rules associated with these complex debt facilities and instruments and code the rules on chain. And I think, right, all these things fit together. You can only do this if it's embedded fully, all the downstream payments fully on chain. But one of the core differences of us versus others is that the logic itself for all these downstream things also take place on chain as well. So if the debt facility says that funds should not be dispersed, as an example, to the end borrower, we can programmatically stop that from happening. Versus on all these other projects, you have debt funds blowing up because all of the rules that are supposed to be enforced, they can't because it's not taking place on the blockchain or on a blockchain.
I think that's a great information to point out for sure. Amazing. Is there anything that you guys want to tell the world that we haven't touched on?
Follow us on Twitter.
Follow us on Twitter. Yeah. Follow us on Twitter. Yeah. Well, just stay with what we're doing, because we are very soon, you're going to see that the financial world, and it may not be in the front page headlines because it's plumbing. You know, people talk about the new house being built. They don't talk about the plumbing being redone. But when the plumbing changes, it's going to mean that borrowing costs fall for everyone. And over the next few years, you are going to see this massive shift, and we are laying those pipes. And so you're going to see the first securitization fully done via stablecoin on our rails. You're going to see that happen in emerging markets. You're going to see it happen in the United States. You're going to suddenly see major banks announcing stablecoin securitizations on our rails. Like, there are going to be some very big things happening. And if you watch, you're going to see it.
We're going to be watching. Eric, Zander, thank you so much.
Thank you.
Thank you.
See you around. Hopefully more discoverable now. Thank you.
Thanks, Alix.
Thank you so much.